So after you issue bonds, a few years down the line, they're then going to be redeemed. So let's take a look at some journal entries for redeeming bonds payable. So this example says Davis LLC issued $400,000 of bonds on January 1st, 2017. We need to prepare the journal entries to record the redemption of the bonds at maturity, assuming that the bonds were issued at 100. So at maturity, at the end of its expected life, these bonds are now being redeemed. So redeeming bonds means that you're paying people back. So if we pay people back, we no longer have bonds payable on our books. So we want to debit to decrease our bonds payable. And then how are we decreasing that liability? Well, we are paying them back. So we will debit bonds payable and credit cash in this entry when we are redeeming bonds at maturity. So how much money are we paying them back? Well, it told us that these bonds were initially issued at 100. They were issued with a face value of $400,000. So we will debit bonds payable $400,000 and credit cash $400,000. Now, redeeming bonds before maturity. So we need to prepare the journal entry to record the redemption of the bonds before maturity at 97. And since it's before maturity, there's still this balance in our premium on bonds payable account. We're going to assume that that balance is $4,000. So a few pieces are going to look similar here. We are still going to be debiting our bonds payable, right? Because we want to get that off of our books. We're also going to still be crediting cash because when bonds are redeemed, we still have to pay people money. Now, there's going to be a few other accounts in between those two, and how we get these numbers is a little bit different than in the first example. We also need to debit our premium on bonds payable. We're told that that account has a $4,000 balance. Well, premium on bonds payable has a normal credit balance. So since these bonds are being redeemed, we need to get that $4,000 off of our books. Our bonds payable amount, that's still just going to be the face value. That number is going to be the face value no matter if you are redeeming it at maturity, before maturity. If you've seen the video on issuing bonds, the bonds payable amount was always face value. The premium, well, we said that we wanted to get that $4,000 off of our books. So we need to debit our premium on bonds payable for $4,000 to decrease that premium account. Now cash takes a little bit of work. So what we need to do is we need to take our face value, our $400,000, and multiply it by 0.97. Because these bonds are being redeemed at 97. So that's at 97% of face value. So 97% of our face value is $388,000. So we will credit our cash for $388,000. So we ended up paying less than what our bonds were worth. If you take a look at your bonds payable and your premium on bonds payable, your premium on bonds payable would increase the carrying value of your bonds. So the carrying value of your bonds right now is $404,000. But we only had to pay $388,000. So we had a gain on bond redemption. We can find this number by taking your bond's carrying value minus the amount of cash that you paid, and you will get $16,000.